Welcome back, my passive income investors, like to the Friday show where we're diving down into the full portfolio updates, which today, still mind staggering because the portfolio is up over $10,000 from last week. Currently, we're $271,316. But more particularly, guys, we're going to go over my 20 stock watch list where I'm going to explain to you guys how I choose these stocks and how I add them to my portfolio because a lot has been going on. Many of you might have been aware from the video I made this week that I sold some of my positions, more particularly GEO Group, which hit me really hard on the dividend side of things. I have been loading aggressively on Alibaba. We have some incredible runners with things like MindMed, and we're going to be dabbling into all of this. So consider hitting that like button, folks, and let's just get right into this. This, folks, do the channel a favor. As always, hit that like button. And if you want to support the channel, you can track your portfolio the same way I do here by going to thechartmaster.com, which, by the way, I'm going to do a full breakdown tomorrow of my favorite dividend trackers because I also promote a free one on here called trackyourdividends.com. But more on that tomorrow. Today, getting right into the portfolio overview. Then we're going to talk about the 20 stocks I plan on buying and how I actually go about buying them. But taking a look, guys, now that I've scaled BABA using some of my line of credit and just going like so aggressive on it, now information and technology is back to a 27% weighting. I remember when I got it down to a 19% weighting, it just fluctuates all over the place. So I'm higher convicted into this sector of the market again, along with, of course, thanks to MyMed going to the moon, Johnson & Johnson going up. We got our ARC-G ETFs within the healthcare space, and now we're sitting on a 20% weighting in healthcare, which I'm a little concerned because most of that is highly aggressive growth here, folks. And then this week, I sold GEO Group. Now, I made a whole video on this. You can go watch it. I'm not going to get too aggressively into it, but it pulled back my overall weighting in the REIT sector. It just slaughtered my dividend income, dropped it massively here, guys, which was pretty painful, but I'm glad I did. GEO Group is continuing to trend downwards, while the stock I bought with that money being Alibaba is continuing to trend up. But that is the portfolio overview for the week, guys. The dividends sit roughly at 7,200. I'm hoping I'm going to be able to get that to scale relatively over the next few months, but let's just get into how I'm picking these stocks and where my focus is moving toward in the future. It hopes that you guys can learn something yourselves. And the way I'm going about picking my stocks has to do with my current risk allocation set, which we can see right here, guys. Now, we kick this off by looking at the individual weightings because obviously we got some new contenders in here with BABA making up 9%, MyMed over 11% today. We got 10% with RioCan, and then finally 9% with Northland Power. These top four companies make up 40% of my overall portfolio. That is a little more aggressive than I would like to be, but over time, as I add new money and as I scale some of these down, like MyMed sometime in the near term, it'll hopefully readjust. But more importantly, it's understanding your risk tolerance here, folks. And right now, my risk tolerance is 25% growth. This would be my Amazons, my Babas, my Microsofts, my Apples, and my Facebooks of the world. And I'm very happy with where it currently sits because I'm at about 24% weighting. This would be slightly higher, but because I use my line of credit to buy BABA, that line of credit automatically gets distributed into the aggressive growth portfolio, which I don't want to make more than roughly 15% of my overall portfolio, which right now is 18% thanks to that leverage. So I'm starting to get a little bit over the teetering because MyMed's blowing up, that credit's in there. So that's starting to grow pretty aggressively, which is the intention behind it, which when those percentages get too large, I'll scale it down and add it to the most important part of the portfolio, which is going to be the 60% allocation going toward dividends here, folks. And right now I sit at 59%. So realistically, 25% growth, 15% aggressive, and 60% dividend plays. You can see the way it's like a Pac-Man chart right here, guys. Basically, anytime, what Pac-Man is eating starts overtaking and eating him, it's time to shift some of those over, which now let's take a look at the 20 stock list I have, because the way I choose these is currently based off the risk category weightings right now, because obviously my aggressive growth is rather large, so I don't want to be adding to that. So I'll touch base on that a little bit more after we go through these stocks. But at the very top of my list, as many of you are aware, I've been trying to add more banks, and TD I've been adding to fairly aggressively. I've got about 4,000 left to buy. You can see on the dollar weighting side of this chart, this is how much I'd like to own of these companies, and essentially over time, time they'll build out as I cost average into them. I need about 4,000 more of TD as I currently going down my holdings here. I currently own about 6,000 of it already. Stag, I need about $6,600 more to finalize the position. Kimberly-Clark, 2,000. Southern Company, 1,000, which I might use some dividends this month to finalize that. And those are the positions right now that I'm most focused on because I've started them. They're almost done. Get them out of the way. Move on to the next ones here, folks, which in line, I'm going to be taking a look at Amazon soon. I'd like to add to the portfolio. Royal Bank, because banks are banks are banks, and they're like Pokemon cards. Got to collect them all. And that'll be the fourth bank that I will be adding to the portfolio. In the utility sector, I really want to add Hydro One. Hydro One is a government-regulated utility that they spun off to go public to raise some capital, I think in 2017, at which basically Hydro One isn't as focused on the hydro production as they are for the delivery lines, bringing them to your house. So it really doesn't matter what changes in the power system. You're always going to need to use the hydro lines. It's been growing pretty nice, so I want to get that one on there relatively soon, if at all possible. Finally, after I sold GEO Group, I need another REIT. I like having 3 REITs, and McDonald's seems like a very safe play to me. I worked there for 3 years as a teenager. I've never added it. I really want to. It's a great dividend growth stock. I mean, the dividend yield starts small, but you got to get some of those safe yielders in there, and this one's been on my list for a while. As materials and kind of industrials, more or less being 3M that produces the N95 mask, which is paying a great yield. It seems like a great company, and it's on my list. It's been on my list for a while. I just never worked my way down to it. And progressively over time, guys, again, as my aggressive growth goes nuts, I'll scale down my metal, constantly use that money along with my own capital to continue building out these other positions. And these other positions will get bought based off the weightings. Like right now, I could use a bit more dividend stocks to keep that weighting at about 60%. So you'll see how I can kind of pick and choose what I'm buying and when I'm buying it, because right now it makes more sense to scale down aggressive growth and increase dividends, and it's a constant waiting game, right? But moving into some ETFs, guys, for my growth fund, I want to add QQQ with Amazon. Those will probably be the last 2 positions I add to my growth, and I'll be done. I'll be pretty happy overall. So we're getting pretty close to finalizing that part of the portfolio. I want to add VOO to the dividend fund. I always told you guys, basically, once I'm happy with the overall portfolio, which will be around $300,000 when it's finalized for me to be happy to where I want it to be. And then I'll start buying index funds, and I'd like to start making those as part of the overall weightings. For some reason, I have 3M on here twice. So let's delete this row. We'll get rid of 3M. I don't know why that was on there twice. Procter & Gamble, obviously Nestle. I got Unilever in here. Those are just some random stocks. I don't really have any conviction toward them. I just like them as dividend stocks. They give me different diversification sets. All involved in consumer staple brands from different sectors of the market. So I wouldn't mind owning all 3 of them, particularly not in the biggest rush for these guys. I'll be patient with those. And then finally, in the aggressive growth side of things, in my aggressive growth fund, I want to focus more particularly making sure at least half of that fund or greater than half is ETF based, because I'll feel a little bit more protected. Yeah, I'll lose some of the explosive upside, but at the same time, I'll still get good growth with way less risk. And I've been taking a look at ARK-K because I already own ARK-G, the genomic fund that Kathy Wood runs, but I'd like to own ARK-K, about $5,000 worth of it. TQQ, which is the triple leveraged QQQ ETF that represents the NASDAQ 100. So basically, the triple leveraged means for every percent that the NASDAQ goes up, this goes up 3 times that. So I've been teetering on the edge about that one, but I'm like, you know what? I could buy a little bit of it, add it to the aggressive growth fund, feel very satisfied with it. The most speculative of the bunch, which will only get added progressively as I scale down MindMed, because it just wouldn't make sense for me to add these currently. I've been taking a lot of these SPAC stocks, guys, when we're talking about ACTC, which is the bus developer. We've got AGT and CCIV. All of these are electric vehicle producers that I think are going to have big headway here in 2021. A lot of YouTubers talking about them right now. So they're going to be part of my aggressive growth fund, hopefully at some point in the near term. So putting that aside, in the near term, the biggest things that are going to likely happen here, if things work out the way I hope they are, which is we're going to see a continued run in Alibaba stock, at which probably sometime around earnings season, I will be taking out my entire line of credit position. I will be paying that back off, deleveraging my aggressive growth fund, while also probably scaling down MindMed, heading into the NASDAQ listing, bringing it down down to a more appropriated weighting for the amount of risk that I have been taking on with it. And then I'll use that to diversify my aggressive growth by buying into the ARK ETFs, along with probably buying some TQQ and also leveraging some of these other aggressive growth plays, because obviously my highest conviction is in MyMed. I would still like to make it the largest, highest risk conviction play I have because I understand it the best, while also averaging these other ones and making them smaller weightings, protecting the diversification of my aggressive growth weighting. And then finally, guys, the growth fund itself, I'm so happy with the positions I have that I just really want to get it finalized by buying QQQ and Amazon, which I will make a priority again once I start scaling down these other positions. I'm way behind on the dividend stocks that I want to own, and I really want to start aggressively adding them in because I do not want to start taking position cuts on my largest weightings, being Ryokan or Northland Power. I love them a lot and they're growing faster than I'd like them to. So to keep those at a risk tolerated level for me, because once they start getting into 15% ranges, it's too much risk for me because they start getting too big for the overall portfolio for me to be comfortable. So I'm trying to aggressively fund my way away from it, and the aggressive growth is helping, luckily, but I can't let them get too big or I'll have to scale them down. So I'm trying to use as much of my own capital as possible to do two primary things right now: buy those dividend stocks and continue growing my emergency fund. I want to build my emergency fund into about a $20,000 position to make it just under somewhere around 7 to 8% of the overall portfolio, just to protect it at this point in case a crash comes along. I can really capitalize on it. And that'll also protect my line of credit that I will be leveraging in to the market periodically when swing trades seem appropriate. So that is where my current mindset sits. Now I pass the question off to you guys. If you made it to the end of this video and you want to buy these charts, go to the Chart Master using coupon code Passive Income Investor, so you saved yourself some money by watching this video and hopefully gained a little bit of knowledge. But as always, I want to know what you think in that comment section below, and stay cool, stay awesome, and I look forward to catching you guys tomorrow.